All right, so we're moving on to chapter 5, fraud, internal control, and cash. So I'm not going to be covering everything on the slides, but you need to go through the slides and make sure that you're familiar with them. All right, fraud is something that unfortunately exists, and employees are guilty of fraud. It is a dishonest act by an employee that results in personal benefit to the employee at a cost to the employer. This would also include falsification of accounting records. In the instance, let's say that you're being paid a bonus based on profitability, you falsify the books to achieve that bonus. So you get your bonus, but you have committed fraud. So there are three factors. And again, I watch a lot of detective shows, and with murder, it's means, motive, and opportunity. Opportunity, of course, is hey, if you have the option of or ability to steal things, you want to try to prevent people from that. Financial pressure, obviously, if you're in a bind and you have that opportunity, you may take advantage of it. And then rationalization. Hey, I deserve it. I work hard. Getting a little extra, I deserve it. In 2001, there were a number of different financial frauds. Enron is probably the most famous. You probably heard of that. But because of that, they introduced legislation. The senators or representatives, I'm not sure which, were Sarbanes and Oxley, so they named it after them, Sarbanes Oxley. Sorry. Um, so it applies to all publicly traded companies. It requires to maintain a system of internal control. Corporate executives and board of directors must ensure these controls are reliable and effective. You have to have independent outside auditors. And then it created the Public Company Accounting Oversight Board, which monitors and provides stipulations to auditing firms. Sarbanes Oxley, if you are the CFO or the CEO, you have to sign off and approve the financials. If it later comes out that the financial statements are wrong, even if it's by accident, you are held liable, which could result in prison, fines, and at the very least, any bonus you receive because of fraudulent financial statements, you have to give back. Internal control is a process designed to provide reasonable assurance regarding uh, the achievement of company objectives related to operations, reporting, and compliance. So the methods, let me see if I can move that. I can. Okay. Methods and measures adopted to safeguard assets, enhance accuracy and reliability of accounting records, increase efficiency of operations, ensure compliance with laws and regulations. So internal control is used in business to safeguard its assets, enhance the accuracy and reliability of accounting records, ensure compliance with laws and regulations, all of the above. Five primary components of internal control: control environment, risk assessment. Where could we be taken? If your house, okay, how could people enter? Windows, doors, garage doors, etc. Control activities. What are we going to do to prevent that happening? Locking doors. We have uh, doorbell cameras, outside cameras, motion detectors, lights, etc. Information communication, talking to your employees, and monitoring, which of course would be the doorbell cameras. Okay, principles. Establishment of responsibility. Control is most effective when only one person is responsible for a given task. So if you limit the ability of people to do things, then what you're doing is you're limiting their ability, you're limiting the number of people that could engage in fraud. So you may, as an accountant, I only had access to information that I needed to do my job. So I did not have access to every accounting uh, part of the company. I didn't have access to revenue, customer accounts, etc., because that wasn't my realm of responsibility. And so then, if something happened, you could limit and isolate the number of people who could have created the fraud. Segregation of duties. Different individuals should be responsible for related activities. If you go to the zoo, you have someone that is taking the money and giving you a ticket. And then you go somewhere else and they're taking the ticket. That is segregation of duties. One person is collecting the money, one person is collecting the ticket. If it was only one person, they could basically go, here's a ticket, you give that back to me. And the next person comes up and goes, all right, give me $20. I'm not going to ring it up and I'm going to give you the ticket. And okay, you can go in. Documentation of procedures. So we only pay on invoice. So if you have an invoice, we're going to pay. If you don't, we're not going to pay. Or if you don't, then we have a special procedure, which probably then goes and has you going through additional steps. Physical controls. You have access to, as a teacher, only certain people have access to that room. So my badge allows me to go to different rooms. You have access to computers where you have your password. You have things locked in safes. You have locked file cabinets. You have alarms, etc. Independent internal verification records periodically verified by an employee who is independent. So you have someone else that comes in and will review those to make sure. Human resources, you can bond employees. I don't know a lot about the bonding process, but I assume that again they conduct background checks. So if you've got something in your record, you're probably not going to be able to be bonded. You rotate employees' duties and require verifications. Now, there's an additional assignment that you have to read or have to a video on fraud committed in Dixon, Illinois. And it's an interesting video. It's not long, but I think you'll find it interesting. But the way that this person was caught finally was she went on vacation and someone else looked at her activities. So you want people to go on vacation and have someone else do their job so an independent mind can make sure you're not, stealing from the company. The principles of internal control do not include, well, management responsibility. An auditor is going to come in and look at your books and they're going to look at the biggest items. So if you want to take money from a company, and I advise against it because you will get caught, you shouldn't take large amounts because people are going to look at large amounts. Large amounts are going, a company will have a hierarchy of who can approve. And if the dollar amount is over a certain amount, so for Shurion is a multi-billion-dollar company, but anything over 5 billion had to be approved by the CFO. Um, Limitations of internal control. In the case of the tickets, you could have collusion, which is two or more people working together to try to defraud the company. That's hard to prevent. Health South was a stock that I bought, and it was a company I researched and thought, okay, they're growing pretty quickly. They seem to be in a pretty good business. And then 3 months later, found out that they had committed financial fraud and it had been perpetuated by 5 continuous CFOs. Now, how do you do that? The first CFO says to the next one, well, hey, I'm leaving, so it's your job. But by the way, you can only have this job if you commit fraud. The first CFO for Health South, I saw a video on him. He couldn't take it anymore and he finally quit. But he said he waited every day for the FBI to show up, and it made him a nervous wreck. They finally showed up, arrested him, and he was a little relieved, actually. Let's see, identify which principles of control activities are violated. Person with primary responsibility for reconciling a bank account and making all bank deposits is also the company's accountant. No segregation of duties. Wellstone Treasurer received an award for distinguished service because he had not taken a vacation in 30 years. Well, you know that violates the human resource control principle. In order to save money on order slips and reduce time spent keeping track of order slips, a local bar does not buy pre-numbered order slips. That's not good. Now, I'll give you an example of that. I worked for a company and we did have pre-numbered receipt slips. We send out statements and we sent it to a patient, and the patient came back and we told him he owed us $2,000. Patient had a receipt that said, "Hey, I paid." And so we determined that they they had paid. They had the receipt. So we ended up finding the person that wrote that verified the receipt. $2,000 was missing. We fired her and we had her arrested. And you may think that's pretty harsh, but if you don't, then other employees are going to think that they can get away with it. But by having pre-numbered receipts, if one of them missing, then you know something's up. And we only knew that only certain people had access to this receipt book. All right, so cash again is the most susceptible to fraudulent activities. So you really want to go out of your way to protect cash. So you want to make sure that the person that is collecting cash separates the information you get with the cash receipts. That goes to the person recording the cash, and then the money goes to the bank, and then that you get that receipt, and that receipt you send to the person controlling cash as well. So again, segregation of duties. And of course, you want to lock cash up. It's easy to take. You just grab it and you can go. Over the counter receipts. One of my children is, see here, over in short account. She's a bank teller, and as a bank teller, she cannot have a difference. One time if it's mistakes, okay. Second time, she's gone. One good thing is that we don't do as much with cash as we used to. So we have EFTs. So that goes directly to whoever you're going to send it to. The world has come a long way. I can send money to my daughter through Venmo. I can pay my brother-in-law through Zelle. So I have a record of where that cash went. Direct deposit of payroll amounts. Okay, then you can confirm that the employee received that. And then debit cards, etc. Now, I will give you one piece of advice. If you can, if you're using your debit card, try to use it in the context of a credit card, because if you do that, you have the protection of credit cards, which is they're limited to your losses. If it as it is a debit transaction, then the bank can basically, and you get taken advantage of, the bank can just say, "Sorry, it's your problem." You should always get receipts for checks. Okay, there should always be something to say, "Hey, what is this for? And who did it come from?" And you should make copies of all of these. Permitting only designated personnel, such as cashiers, to handle cash receipts is an application of the principle of, I'm going to go with establishment of responsibility. Voucher system controls. Okay, so most companies, larger companies, have a purchase order system. And so what happens is I want to buy 1,000 computers, and they're $300. Well, that's unrealistic. $1,000 a piece. So I go to Dell, and Dell, I issue a purchase order. Say, okay, I've agreed to buy over the course of a year 1,000 computers costing $1,000. And so then I've created a purchase order, send that to Dell, then I get half of those. So the entity in my organization that receives these computers is going to either send this receipt of items to accounts payable, or they're going to enter it into the system. And then Dell sends an invoice for those 500 computers. So now you have the purchase order that's authorized to purchase up to 1,000. You have the receipt. Yes, I verified I've received 500. And now you have the invoice for those 500. And so then you can create a voucher that goes to whoever approves payments and go, all right, I've got all these pieces of paper that says I'm authorized to buy it. I've received them, and the bill is correct. The use of pre-numbered checks in dispersing cash is an application of the principle of documentation procedures. All right. Um, Petty cash. I don't know anybody that has petty cash anymore, so we're going to skip through that. And you won't be responsible. All right. So a lot of you probably have bank accounts. You don't reconcile your bank account. You basically go, hey, I've got this much in the bank, so I'm good, right? I use a software that basically communicates with my bank, with my investment accounts, with my credit card accounts. So every day I reconcile all of my accounts. And it's come in handy because at one point a few years ago, someone walked into a bank in Goodlettsville and in two separate instances got $3,000 and then $1,500 posing as my wife. I Because I hooked up to the bank every day, I was able to see this. We called the credit card company. They said, no problem, we'll take care of it. I didn't have to pay you that. And they were able to quickly respond. But normally, companies have to do bank reconciliation. So, in other words, they're going to go, all right, I have entered all my cash transactions in my general ledger into my cash account. And so I have a balance based on all of those transactions. And then at the end of the month, I'm going to get a bank statement. And I want to reconcile and basically prove that I have this eventual same balance. And so there are items that are going to appear on the bank statement that I have not entered into my accounting system yet. And there are going to be timing differences on the bank statement. So, in other words, if I make a deposit on 3 o'clock on the last day of the month, and a lot of companies do, they may have a lot of small checks and say, we got to get this in before the end of the month. That might not show up on my statement until the following month. So those are deposits in transit. Meanwhile, I've issued checks and yet they haven't been cashed. So I've already recorded them, but they haven't hit the bank. So that's a difference. On the book side, there may be the book side, I'm going to look at everything that's in the bank statement, not in my accounting system. It could be fees, it could be non sufficient checks, it could be customer deposits that I haven't recorded, it could be errors. All right. So the end result here is that, again, that's a great thing about banking. This is, you know, fairly new, but still you can make a deposit from your smartphone, which I do quite often. All right, so you get a bank statement, and then you're going to have to go and reconcile this. All right, so the control features of a bank account do not include having bank auditors verify the correctness of bank balance per books. Okay. All right, so you have the book balance. Again, my accounting system, I've entered all these transactions and the bank balance, what's actually hit the bank. All right. And you have these time lags again, uh, deposits in transit and checks that haven't been cashed. All right. So reconciling items or time lags, errors. And you can see here what we're going to do is we're going to take the bank balance and then we're going to add in deposits and transits, subtract checks not um, cash, And that's going to come up with a balance. And then we're going to take the books and we're going to look at what's on the bank statement. We have it recorded. And then at the end, these two amounts should match. Okay. So here are the different items. We have deposits in transit of 2201.40, checks that have been cashed of 5904. We have unrecorded electronic receipt from customers. So that's something that hasn't been recorded in the accounting system. And these other items haven't been recorded in the accounting system as well. So we're going to add the deposits in transit, subtract the outstanding checks, and so we're done with the bank statement side. Then we're going to add the electronic funds, add the error in the check, subtract the non-sufficient funds check, subtract the debit and credit card fees, and subtract the bank service charge. And if we've done it correctly, these two amounts are going to match. So you do need to know basically what goes where. And really, you may be even given a problem like this. I would do this side. And so here's just, representation. And again, now, when you've reconciled and you see everything that's on the statement that you haven't entered into your accounting system, you're going to have to make these journal entries. The reconciling item in a bank reconciliation that will result in adjusting entry by the depositor will be bank service charges. And then cash. Cash consists of coins, currency, checks, money orders, money on hand, or on deposit. It's always listed first. Cash equivalents are short term, highly liquid investments that are both readily convertible to known amounts of cash and so near maturity that the market value is relatively insensitive. So, again, if you buy a bond, the bond price is going to change daily, but you're so close that the change is going to be minimal and you're going to be able to turn it in for whatever it was anyway. And then restricted cash are just amounts that, well, you can only use them for this purposes. And so here is current assets, Delta Airlines. Which statement correctly describes the reporting of cash? Cash cannot be combined with cash equivalents. Wrong. Restricted cash funds may be combined. Wrong. Cash is listed first in the current assets. Yes. So if you have a negative balance in your checking account, that's a liability. You owe the bank money. Because cash and cash equivalents often include short-term investments, accounts receivable should be reported as the first item on the balance sheet. I don't agree with that. Okay. False. Oh, I see. And then the thing about cash is that we're in GAAP accounting. And what you'll see is that GAAP accounting, again, because of deferrals and accruals, that is not the same as cash basis accounting. So cash collections, cash expenditures are not going to necessarily tie with GAAP cash accounting, and that's why we have a statement of cash flows. And that's why also when you do a budget, you have to budget for cash. You have to go, well, I'm going to sell this a month, so I'm going to increase my sales, but I'm not actually going to collect that increased amount until the further month. Same thing with, well, if I'm going to be spending more, I have an agreement that I will have 30 days to pay, so I won't have to actually make that payment, even though I'm going to expense that amount. Shows anticipated cash flows, usually over a 1 to 2 year period. Cash receipts, cash distributions, and financing activities. Where's my cash coming from? What am I going to spend it on? And here would be an example of the cash budget. Right. Well, that's all for this. Let me get to this part. And again, there will be an additional video that you need to watch. Although I think you'll find that interesting, and that will be on the fraud in Dixon, Illinois.